Have you ever heard someone complain about earning more money because they state it'll push them into a higher tax bracket? Every time I hear this, I can't help but think perhaps they just don't understand marginal tax rates. And that's okay. Marginal tax rates are not very intuitive. So in today's video, I'm going to explain what marginal tax rates are and compare them to effective tax rates. We're also going to go through an example at the end to really drive the point home. Hi, my name is Alex and I'm a certified public accountant. If you enjoy this video, please check out my other videos on tax planning and personal finance. So let's start with your marginal tax rate. Now, the income tax system in the United States is what's known as a progressive tax system, meaning that as you earn more money, you're taxed at higher and higher rates. Now, your marginal tax rate is the rate or percentage that you're taxed on the additional dollar that you make. Let's compare this to your effective tax rate. Your effective tax rate is your total tax throughout the year divided by your total income throughout the year. This is usually lower than your marginal tax rate because not all your income is taxed at your highest marginal tax rate percentage. Let's jump into an illustration to help better understand. The marginal income tax rate system is like filling up buckets. The only rule is you must go in order filling up these buckets. In other words, you cannot start filling up the next bucket until the one before it is already full. And if you start removing contents from a bucket, you must start from the end and work your way backwards. Since you are going one at a time, adding or removing contents from one bucket does not immediately affect the contents of another bucket. That is, until you transition to that other bucket. Now let's apply this bucket illustration to a marginal tax rate example. Let's say you have a friend who earns $50,000 a year in taxable income. For hypothetical purposes, let's assume their tax brackets are 10% on the first $10,000 they earn, 20% on the next $30,000 they earn, and 30% on anything they earn above $40,000. This results in our friend paying $1,000 in tax on his first $10,000 in income, $6,000 in tax from his next $30,000 in income, and $3,000 in tax from his last $10,000 in income. In this example, our friend is in the 30% marginal tax bracket, and his effective tax rate is 20%. Notice his effective tax rate is lower than his marginal tax rate because he's not charged that high 30% rate on his entire income, just on the last portion. So there we have it. I hope that illustration and example helped you better understand marginal and effective tax rates. If you found this video helpful, please check out my other videos on tax planning and personal finance. Thanks for watching.